Something big is happening, and if you're paying attention, you can feel it. The fuse has been lit. Exploding national debt, soaring gold prices, banks teetering, and interest rates refusing to come down. We're being told everything's under control, but is it? Or are we racing towards a tipping point with uncontrollable inflation, high interest rates, and economic turmoil? And here's the kicker. Treasury bonds, what are supposed to be the safest investments, are collapsing. Banks, they're sitting on huge unrealized losses. They're like ticking time bombs. And gold, it's at all-time highs. Some say this is all just market noise. Others, like Brian Kim of ClearValueTax, believe we're already beginning what he calls the great melt-up, a hyperinflationary boom that ends with a crash.
I want to tell you about the upcoming melt-up. So this is a story about inflation, how it reaccelerates hard. So you know how we had the Great Recession? Well, I'll coin this event the Great Melt-up. And it will happen. It is inevitable. Federal Reserve and the US government have chosen hyperinflation rather than deflation. It's going to get worse. It's going to get exponentially worse. I wish I could describe it in a different way, but I've chosen my words wisely. It is my belief that the US government will manufacture a crisis in order to refinance their national debt.
But what if it's more than that? What if what's coming isn't just a melt-up, but the beginning of a complete reset of our financial system? Let's dive in. By the way, I'm Noel Lorenzana. This is not financial advice. Do your own due diligence. I need to mention that I filmed this video before Trump's surprise victory, which ultimately I think is a good thing for the country. I'll be honest though, I got caught up believing the mainstream media bias, and that won't happen again. Sure, the US dollar strengthened immediately, the stock market's rallying, and gold looks like it may have hit a peak. But honestly, I don't think it changes the bigger picture. It might just delay the inevitable. We're on this path regardless, and at this point, it's like trying to turn around a Titanic-sized ship, and it's too late to avoid hitting an iceberg. Let's talk about the elephant in the room, US national debt. And no, this isn't just numbers on a screen. This is about a government that's been recklessly spending taxpayer money for decades, and it's piling up debt without a plan to pay it back. And now the bill is coming due. Check this out. As of October 17, $500 billion was added to the national debt in just 3 weeks. That's 3 weeks, folks. The US government isn't just borrowing a little more each year, it's borrowing trillions annually, with deficits projected to grow even higher. The amount of debt is staggering. They'll never be able to pay it back without inducing hyperinflation, in my opinion. What makes this even more alarming? The interest payments on this debt are rising faster than ever. Reports indicate that the debt is growing at a rate of 1 trillion approximately every 100 days. Plus, every time the government rolls over its debt, it has to refinance at higher interest rates. And you know what else is out of control? Debt to GDP. Typically, economists sound the alarm when debt exceeds 100% of GDP, or gross domestic product. But the US is already well past that threshold, currently at 121% and climbing. This isn't just a theoretical problem. Here's what this means for you and me. As debt keeps growing and interest payments eat up more of the government's budget, there's less money for everything else. That's fewer public services, more taxes, or worse, printing even more money just to keep up. You all know Brian Kim from ClearValueTax. He's put out some really good videos on what he's calling the Great Melt-up. His theory goes like this. As national debt spirals out of control, hyperinflation will emerge as the de facto policy tool, whether intentionally or as an inevitable consequence of unchecked spending and unsustainable government debt. Think of it this way. The government can reduce the real value of its massive debt burden by allowing inflation to drive up prices. As everything around you gets more expensive, the dollars in your pocket lose purchasing power. But those same now devalued dollars make the debt easier to pay down, since the debt amount stays fixed but the value of the currency declines. Think about it. In the end, the government would be paying off trillions of dollars with money that's worth less. It's a strategy that's both brilliant and unsettling, because while it makes the national debt easier to manage, it comes at the cost of everyday people's savings and purchasing power. Let me show you a real-world example of what devalued dollars look like. Now look at this vintage ad. Imagine buying this 4-bedroom house from 1958 with today's dollars. Back then it was $11,990, an amount that seems incredibly cheap by today's standards. That's the effect dollar inflation has over time, and in the case of hyperinflation, it could make the massive US debt easier to pay down because the dollars used to repay it would be worth far less. Does that make sense? And here's another biggie. While debt is exploding, interest rates aren't coming down anytime soon, and that's next. Here's where things get even more puzzling. Despite the Fed lowering its benchmark interest rate, borrowing costs are still sky high. The 30-year fixed mortgage rate just moved up to above 7%. Whether it's mortgages, business loans, or credit cards, the rates just aren't coming down. And this disconnect between the Fed's policy of lowering interest rates and what we're experiencing in the real world could spell trouble. Let's talk about why aren't interest rates coming down? If you think about it, lenders aren't just concerned about inflation, they're worried about credit risk, the possibility that borrowers won't be able to pay back their loans. And with banks facing instability and uncertainty about defaults, lenders demand higher interest rates to compensate for this extra risk. This reflects a lack of trust in the financial system, which leads to tighter credit conditions. Even though the Fed is lowering its benchmark interest rate, borrowing remains expensive because lenders are building in higher premiums to offset future risks. Treasury yields also play a key role in setting borrowing rates across the economy. When Treasury bond prices fall, yields rise. And those yields serve as benchmarks for everything from mortgages, credit cards, to personal loans. Even if the Fed lowers the federal funds rate, it doesn't guarantee lower borrowing costs. I mean, they wish it did, but it doesn't, because the bond market ultimately holds significant influence over long-term interest rates. When bond investors demand higher yields, it pushes up interest rates for businesses and consumers. Right now, the bond market is flashing a warning signal, so brace yourself. As bond yields rise, it becomes more expensive for banks to borrow money and for people to take out loans. This makes it harder for everyone to access credit, which can naturally slow down the economy. This disconnect between the Fed's policy and real-world borrowing costs feeds directly into Brian Kim's melt-up theory. If borrowing remains expensive, businesses stop expanding, consumers stop spending, and banks become more cautious. This creates a cycle where economic activity slows, but asset prices like the stock market, gold, and real estate continue to rise as investors look for safe places to park their money. So here we are, stuck in a world where borrowing's more expensive even when the Fed tries to ease things up. And guess what? This feeds right into Brian Kim's melt-up theory. If you're a homeowner or small business owner, this means you're going to feel the squeeze. Refinancing won't get cheaper anytime soon, and if you're carrying credit card debt, well, now's the time to get serious about paying it down because of higher interest rates. And while rates stay stubbornly high, something even more concerning is unfolding in the background. Treasury bonds are falling, and they're the bedrock of the financial system. Let's go over what that means. Treasury bonds, these are supposed to be the safest investments, but they're starting to sell off. And when bonds go through this type of decline, it's a warning sign that we could be headed towards economic turbulence as even the safest investments begin to lose their stability. Let's talk about the relationship between bond prices and yields. When bond prices fall, their yields go up. They have an inverse relationship. Rising yields mean that borrowing becomes more expensive for everyone, from the government to regular folks like you and me. For years, countries like China and Japan bought US treasuries to stabilize their own currencies. But lately, these buyers are backing away, which means the US Treasury has to sell bonds at lower prices in order to attract new buyers. That's also why we're seeing yields spike. Investors are increasingly questioning if bonds aren't safe, then what is? This uncertainty pushes them toward alternative assets like gold, silver, or real estate, among others. As bond prices fall and yields rise, the government faces higher borrowing costs, making it harder for them to manage its debt. With a larger share of the budget going towards interest payments, the pressure on public finances increases, further weakening market confidence. It's kind of a vicious cycle. Brian Kim believes this shift could also trigger a melt-up in the stock market, where prices soar before everything crashes. I mean, think about it. The stock market is already very high and richly valued. Could we already be witnessing the great melt-up? Now, if you thought the stock market was volatile, the real risks may actually lie in the bond market. A declining bond market can be a sign that things are getting tougher, not easier. It affects everything, your mortgage, credit card rates, and even your savings. If this trend continues, it could be wise to consider diversifying where you hold your money and be cautious about locking funds into long-term fixed-rate investments until the market shows signs of stabilizing. And this instability doesn't stop with bonds. Did you know that banks are sitting on massive unrealized losses in these very bonds and commercial real estate? As mentioned earlier, bond prices and interest rates have an inverse relationship. Higher rates, lower bond prices. If those losses become real, we could see a wave of bank failures. Let me show you how close we are to that tipping point. This is where things get serious. Banks aren't just managing deposits, they're also heavily invested in treasury bonds, commercial real estate, and other securities. And right now, those investments aren't doing very well. Many banks are sitting on massive unrealized losses, meaning if they had to sell those today, they'd lose billions. If these losses become real, we're looking at a potential wave of bank failures. Take a good look at this chart. This chart shows how much banks are losing on investments they haven't sold yet. Total unrealized losses hit $516.5 billion, increasing by $38.9 billion from the last quarter. The losses in this chart come from long-term investments like mortgage-backed securities, including those tied to declining commercial real estate. As interest rates rise and the value of commercial properties drops, the market value of these securities falls as well, leaving banks with huge unrealized losses. If banks are forced to sell these assets to meet withdrawals or other financial obligations, those losses could become real, putting further pressure on commercial banks. The FDIC recently reported that these unrealized losses are building up across many regional and even larger banks. And with borrowing costs still high, banks are under pressure. Fewer loans, fewer profits, and more risk. If you follow Warren Buffett, he sold a staggering $10.5 billion of Bank of America stock in a matter of months. And this isn't the first time Buffett has made big moves in the banking sector. Between 2020 and 2022, he completely exited his positions in JP Morgan Chase and Wells Fargo, signaling his cautious outlook on the financial industry. What do you think this could mean, if anything? Let me know in the comments. Now, these banking concerns might not seem like a problem unless people start pulling their money out of banks, but we've seen this before. A loss of confidence can spread fast. Remember Silicon Valley Bank? Once depositors get nervous, they run, and banks are forced to liquidate their portfolios at a loss. That's where things start to break. So what can you do? Keep an eye on your bank's health. If your bank holds large amounts of long-term securities and rates keep rising, those unrealized losses could quickly become real. To protect yourself, consider spreading your savings across multiple institutions to reduce risk. Look into FDIC insured accounts and keep individual account balances under the insurance limit of $250,000. And be cautious with investments in bank stocks. And with gold and silver hitting new highs, many are seeing these metals as the safest bet right now. But is this just another bubble, or are gold and silver indicating something ominous? Let's explore that next. People are waking up and they're losing faith in fiat currencies. When bonds fall, bankers worry, and as debt goes through the roof, people lose confidence in paper currency. Historically, whenever governments overextended themselves, gold and silver become the go-to safety nets. Gold is obvious. It's been money and a safe haven for thousands of years. In uncertain times, it holds value when currencies falter. It acts as a hedge against inflation and economic instability. That's why people, investors, and even central banks flock to gold when trust in the system erodes. Think of it as financial insurance. Silver as well, to a lesser extent. It's also a key industrial metal used in everything from solar panels to military tech. In fact, it's said that a single Tomahawk missile contains about 500 ounces of silver. As military and green energy demand rise, silver's structural deficit grows. More silver is used than mined each year. Then there's also talk of price manipulation, that governments suppress silver prices to keep it cheap for military use. I don't know, but I made a video on that, which you can check out up here. But whether that's true or not, one thing's clear. Demand is far outpacing supply, and that's pushing prices higher. So why does this matter? With gold and silver rising, it's actually a symptom, not a solution. When people move into precious metals, it means they've lost faith in the system. It's the last lifeboat, if you will. And once people start selling everything else to buy gold, it feeds into the very melt-up theory Brian Kim warns us about. Rising gold and silver prices are like the canary in the coal mine. They might just be signaling that something bigger might be coming. And it's not just about inflation anymore. It could be about financial survival. So where does this all lead? Exploding government debt, stubbornly high interest rates, collapsing bonds, banks struggling, and gold prices at all-time highs. These aren't just isolated events. They're all pieces of the same puzzle, and together they paint a picture. Are we already witnessing the early stages of the great melt-up? Let me know what you think in the comments. Our government keeps on borrowing and spending, pushing debt to unsustainable levels. To manage that debt, they print more money, which inflates asset prices and pushes inflation higher. As bonds collapse, banks holding those bonds face mounting unrealized losses. If those losses turn real, we could get a wave of bank failures, forcing more people to pull their money out and move it into safer assets like gold and silver, or in the stock market as Brian Kim anticipates. And just like that, we enter the great melt-up. Asset prices soar, trust in the system erodes, and what starts as an inflationary boom ends in a catastrophic bust. And here's the dangerous part. Once the fuse has been lit, there's no easy way to put it out. We're now in what looks like a race between runaway debt, potential bank problems, and a seemingly desperate rush towards safe haven assets. So what can you do? Consider diversifying your savings. If needed, spread it across multiple accounts, ideally staying under FDIC insurance limits. Consider allocating some savings to gold or silver, not as an investment, but as insurance against financial instability. I'm not a big believer in cryptos, but many are. But maybe consider allocating some savings to cryptocurrencies like Bitcoin. If you have debt, consider paying it down if you can, because with interest rates staying high, carrying debt can become very expensive. Make a plan to reduce high-interest credit card debt as soon as possible. Stay informed and flexible. The situation is changing rapidly. Keep an eye on Treasury yields and bank health indicators like FDIC updates, and be ready to move your money if things get worse. Some say this melt-up could trigger the end of the current financial system, leading to what some call as the Great Reset, with a move toward new currencies, possibly central bank digital currencies, or even a gold-backed system. Whether or not that happens, one thing is clear. The system we've relied on is changing, and we need to be ready for what's next. It's quite possible we're living through a turning point in financial history, and the choices we make now will determine how we come out on the other side. I'd love to hear your thoughts. Do you think we're in the great melt-up already, or are we heading for something worse? Or have I completely lost my mind? Let me know in the comments below. And if you found the video helpful, hit that like button and subscribe, because this financial story is just getting started, and I'll be here to help you stay ahead of the curve. And before you go, if you've enjoyed the content and want to support the channel, consider checking out my Patreon. It's a great way to help me keep making videos like this one, and you'll get some exclusive perks as well. The link's in the description if you're interested. Thanks so much for watching, and see you in the next video.